Send the link. So hello everyone. Good evening. So now I am going to discuss today's direct taxation question paper. I feel the question paper is easy. I am going to reveal all the MCQs for you as well. You can comfortably answer the MCQs, and descriptive questions are also easy only, except one or two. Little bit, one or two adjustments are tough. That's it. Rest all, the question paper is fantastic. So first, let us start solving case scenarios. Let us start with case scenario 1. Renu, a resident individual aged 48 years, owns 2 flats in Hyderabad. She lives in flat A and gave flat B to her in-laws for residential purposes. We already know, we have discussed in house property up to 2 house properties. 2 house properties can be self-occupied. If there are more than 2 self-occupied properties, third self-occupied property, even though it is self-occupied, it will be treated as deemed let out property. Correct? Next, she does not charge any rent from them. So both are basically self-occupied properties. In the month of April 2024, she entered into an agreement to buy flat C from a builder in the same area as her other flats are situated. In the month of September 2024, she took possession of the flat and started spending her weekends thereafter, paying a token amount of 11,000 to the builder. See, the moment some consideration is paid and there is agreement and possession is taken, it will be assumed buyer is deemed owner of the house property. Okay. However, flat C is still not registered in her name. See, the moment it is possession is taken, we can treat she is the owner and physical registration is not required. All 3 flats are identical in size and other aspects. She had one more flat D which was let out at a monthly rent of 45,000 to Mr. Shub during financial year 21-22. Don't get confused. It is not let in 24-25, it was let in 21-22. So in 24-25, she is owner of only 3 house properties. Okay. From 1st April 21 to 31st March 2022, Mr. Shub did not pay any rent for 3 months. Renu sold the flat on 31st March 2024. She owned, that means what? In 24-25, she is not owning that property. It was sold in 23-24 only. Okay. 31st March 24 means it was sold in 23-24. She owned 5,000 shares of PQR Limited listed on a recognized stock exchange in India, an Indian company which were acquired on 1st February 2022 for 180 per share. On 1st January 2022, company bought back 2,000 shares. There is an amendment in Finance Act 2024. Whenever buyback is done, buyback amount will be treated as deemed dividend and it is taxable under section 222 clause F. Okay. So how much is taxable as deemed dividend? 2,000 into 420. How much? 8,40,000 is taxable as deemed dividend under income from other sources. So this is the explanation. Now let us see the answers. Which of the following statements is correct as far as taxability of income from house property is concerned? Any two flats will be treated as self-occupied, whereas third flat will be treated as deemed to be let out. This option is correct. Assume Shub pays arrears of rent to Reno on 28th June 2024. See, from 1st April 21 to 31st March 2022, flat was given on rent to Mr. Shub. 3 months rent was not paid. So 3 months rent is unrealized rent in 21-22. In 24-25, Shub paid the unrealized rent. So if there is recovery of unrealized rent, how much? 3 months na? 45,000 into 3, 1,35,000. From 1,35,000, straight away 30% deduction is allowed. How much? 30%. 1,35,000 into 30%, 40,500 deduction is allowed. How much is balance? 94,500 is taxable. This is the answer. Next. Which of the following statements is correct as far as taxability of buyback of shares? See, at the time of buyback of shares, 8,40,000 will be treated as deemed dividend in the hands of Renu. This is the correct answer. So, very simple case law, 6 marks easily you will get. Next. Shall I explain case scenario 2? Everybody. Yes, now let us see case scenario 2. Sudipto, a resident individual, aged 54 years. Give me 1 second. Just 1 second. Now, resident individual aged 54 years gifted shares of Indian company listed on a recognized stock exchange in India to his friend Shanu to help him financially on 1st April 2024. Gift deed states that shares will be transferred back to Sudipto in the event of death of Shanu. That means this is the case of revocable transfer, but property will not be revoked, taken back during the lifetime of the transferee. After the death of transferee only, property will be taken back by transferor. Generally, in case of revocable transfer, clubbing provisions will get attracted. But even though this is revocable transfer, the shares are not revocable during lifetime of transferee. So, clubbing provisions will not get attracted. Income on shares is taxable in the hands of transferee only. Okay. Fair market value of shares on the date of transfer was 54 lakhs. Shanu received a gross dividend of 4,50,000 on these shares during financial year 24-25. Sudipto is engaged in business of retail trade as proprietor. During financial year 21-22, he paid 25,000 per month to his wife Swati as a salary, being the marketing in charge. Swati does not have any professional qualification or experience for the job. See, if she does not have adequate professional qualification, clubbing provisions will get attracted. But this is when this is in financial year 21-22. In 21-22, clubbing provisions will get attracted. Right now, we are in 24-25. So in 24-25, let us see what is the case. This income was clubbed in the hands of Sudipto as per clubbing provisions. Superb. Swati started her MBA studies and did not get any salary from 1st April 2022 to 1st December 24. She completed her MBA on 1st December 24 and again joined. See, after completion of MBA, if she joins in her husband business, then she is having adequate technical or professional qualification. In this case, clubbing provisions will not get attracted. Entire salary received by wife, entire salary received is taxable in the hands of wife only. Okay, it is taxable in the hands of Swati only. During financial year 24-25, Sudipto paid 54,000 as medical insurance premium by way of account pay check for his senior citizen parents who are non-residents. See, the person who is paying the medical insurance premium. If he is resident, sufficient, he can claim it as deduction. Even though parents are non-residents, still deduction is available. But Sudipto is aged 54 years. That means he is aged less than 60 years. Even though he is aged less than 60 years, parents are senior citizens. So now let us see, based on above facts, answer the following MCQs. Assume other incomes of Sudipto and Shanu is 55 lakhs and 11 lakhs respectively. Which of the following statements is correct? So, see, this is revocable transfer, but it is not revocable during lifetime of transferee. So nothing is clubbed in the hands of Sudipto. It is taxable in the hands of Shanu only. So dividend income shall be taxable in the hands of Shanu, as clubbing provisions will not apply in this case. This is the right answer. Next, which of the following statements is correct as far as clubbing of salary of Swati for financial year 24-25 is concerned? See, salary of Swati will be taxable in her own hands because she got MBA qualification. After MBA qualification, she is having adequate qualification. Clubbing provisions will not get attracted. It is taxable in the hands of Swati only. Next, what shall be the amount of deduction under section 80D in the hands of Sudipto, assuming he has opted out of default tax regime? See, for this, parents are senior citizens. So even though they are non-residents, still 50,000 deduction you can claim. For senior citizens, maximum deduction allowed is 50,000. Ravi, an Indian resident, bought an overseas tour package from Karthik, also a resident Indian and a seller of overseas tour programs, and paid 7 lakhs as cost. See, in case of overseas tour package, what is the rate of TDS? There is no threshold limit available for overseas tour package. If cost is up to 7 lakhs, rate of TCS is 5%. If it is more than 7 lakhs, rate of TCS is 20%. As here it is up to 7 lakhs, rate of TCS is 5%. I think this is 35,000, 7 lakh into 5%. Next, he also remitted 12 lakhs to USA under LRS, liberalized remittance scheme of RBI, for the purpose of investment in USA share market. Hold on, I will come back to your answers. Let me discuss question number 7. A resident authorized dealer, what shall be the aggregate amount of tax to be collected? See, 12 lakhs is sent for investment purpose. Out of 12 lakhs, 7 lakhs no TCS threshold limit. Balance 5 lakhs, rate of TCS 20%, 1 lakh rupees. So, total TCS is 1 lakh and 35,000, 1 lakh 35,000. Yeah, question number 5, assessing officer point MCQ, sir. Sir, assessing officer satisfied, then only clubbing will discontinue till clubbing in the hands of Sudipto. See, I do not know your name, but irrespective of that assessing officer, if nothing is specified, we can take reasonable assumption. In case of revocable transfer, if it is not revocable during lifetime of transferee, then clubbing provisions will not get attracted. Here, no clubbing will be there. Clubbing will not be done in the hands of Sudipto. It is taxable in the hands of Shanu only. Yes, she rejoined after education, no sir. Yes, that's why clubbing provisions will not get attracted. It is taxable in the hands of Swati only. If she is not having qualification, clubbing provisions will get attracted. As she is having qualification, clubbing provisions will not get attracted. They are taxable in the hands of Swati only. Okay. Next, question number 8. AP and Sons HUF is controlled by Amarendra. The Karta of HUF, Amarendra, stays in country T and regularly visits India. During financial year 24-25, he visited India for 190 days and managed affairs of HUF. During immediately preceding 5 years, he visited India for 70 days each year, and prior to that he was in India for 185 days in every year. Residential status of AP and Sons HUF for assessment year 25-26. Now, hold on. See, when he came to India, he managed affairs in India. So, control and management affairs are partly in India. If control and management affairs are partly in India, HUF becomes resident in India. So, HUF is resident in India. We need to check whether Karta satisfies additional conditions or not. If Karta satisfies additional conditions, HUF becomes ROR. If Karta do not satisfy additional conditions, HUF becomes RNOR. Okay. Now, HUF, first of all, HUF is resident in India. Karta, in 24-25, he stayed in India for 190 days. In last 5 years, he stayed in India for 70 days each. That means total how many days? 17 to 5, 350 days. And in last 5 years, he stayed in India for 185 days each. 185 days. 185 into 5, 925 days. Now, that means in these 5 years, he stayed in India for more than 182 days. So, for 2 years, if he is there more than 182 days, additional condition 1 is said to be satisfied. And if you add 350 days plus 185 days plus 185 days, total 350 plus 185 plus 185, 720 days, which is less than 730 days. Additional condition 2 is not satisfied. As additional condition 2 is not satisfied, Karta did not satisfy additional conditions, HUF will become RNOR. Okay, so answer D. Resident, because control and management is partly in India and not ordinarily resident, because status of Karta is resident but not ordinarily resident. And see, in this case, Sudipta age is less than 60 years. Sudipto age. But his parents are senior citizens, na? His parents are senior citizens. That means above 60 years. And I have one doubt also here. As parents are generally senior citizen means resident individual above or equal to 60 years. Here, as he is senior citizen who is non-resident, as parents are non-residents, we may not treat them as senior citizens and deduction may not be available under section 80D. So, I feel nil is the answer. See, 25,000 or 50,000, it depends upon normal citizen or senior citizen. If they are resident, like if they are non-residents, basically, generally senior citizen means resident individual whose age is greater than or equal to 60 years. But resident individual whose age like non-residents we do not call as senior citizens. The thing is, as parents are non-residents, I don't think deduction is available. Deduction is zero. So these are all MCQs when it comes to descriptive questions. Descriptive questions are a bit easy only. Question 1, total income adjustments are very easy. Depreciation as per income tax rules, that is given. Additional depreciation is given. See, in the question, he asked you to do under both tax regimes. When you are doing under default tax regime, you should add back additional depreciation. Next, interest for advance tax, that is also not allowed as deduction, that is to be disallowed. 3,50,000 paid to contractor for carrying out whitewash work at a factory premises. Tax was not deducted on this payment and contractor did not file his return of income for the relevant previous year. See, in 24-25. One more thing. Here it is assessment year 24-25. Assessment year 24-25 means earlier year, na? So anyhow, whether it is earlier year or current year, interest on advance tax is not allowed as deduction. That is disallowed. That needs to be added back. Contribution to Prime Minister Relief Fund, that is also to be disallowed. And it will be allowed as deduction under section 80G. Expenditure towards advertisement in political party, this is also not allowed as deduction. That is to be disallowed. And this is also not allowed as deduction under 80GGC. Interest on term loans obtained from cooperative bank not paid before due date for filing ITR. Even this interest is also not allowed as deduction because section 43B applies here. If you take loan from cooperative bank, you should pay interest. If you do not pay interest, it is not allowed as deduction in current year. It is allowed as deduction on cash basis. Contribution towards pension scheme of employees 1,50,000. Ujjwal 25,000 or 50,000. I feel it is zero because generally if they are resident senior citizens, then only 50,000 deduction is available. In the eligible salary and dearness allowance for pension scheme referred to under section 80 CCD. See, contribution by employer to pension scheme up to 14% allowed as deduction. Beyond 14% it is to be disallowed. MCQ कर दिया मैंने, चेक पहले. आफ्टर कंप्लीशन ऑफ MCQs मैं theory बोल रहा हूँ. दर्शन शाह, प्लीज. Industrial power tariff concession of 2,50,000 received from central government. Okay, see, this is government grant and it is taxable under PGBP. Interest from bank fixed deposits, this is taxable under income from other sources. It should not be credited to P&L account. We will disallow it. Cash gift from father, generally gift is taxable under other sources, but here it was credited to P&L account. You should not credit to P&L account, so you will disallow it. Okay. And cash gift from father is not at all taxable. So adjustments are simple only. You can do. There is additional information. Expenditure pertaining to 23-24 was allowed on due basis, but paid in current financial year on cash basis. See, more than 10,000 you should not make cash payment. But in earlier year, you claimed it as deduction on accrual basis. In current previous year, you have paid in cash basis. So this total 35,000 will be treated as income in current previous year. Next, audit fees for previous year 23-24 75,000. TDS but not deposited in relevant previous year. TDS deposited. See, whenever you are making payment and you are required to deduct TDS, you should deduct TDS, and deducted TDS is to be deposited to government. If you do not deduct TDS, if you do not deposit TDS to government before ITR due date, then it is not allowed as deduction. When it was deducted after ITR due date of 23-24. So in 23-24, it is not allowed as deduction. In 24-25, it is allowed as deduction. So in current year calculation, like whatever 75,000 into 30%, how much? 22,500. That will be allowed as deduction in 24-25. Next, this is second question. 2A. Sweta, citizen of India, is a chartered accountant. She is working. See, all these descriptive questions, they are also easy only. Expected, I told. Second question, first part will come from residential status. It came from residential status. Second part, I said it will come from TDS. It came from TDS. Next, third part, like capital gains, simple only. And this is also from salaries, simple question. And this is relating to set off of losses. 6 marks question is asked from set off of losses. Superb. And this is very easy. Who is not required to pay advance tax? If expected tax liability is less than 10,000, advance tax is not required to be paid. Resident individual who is senior citizen and is not having business income, they are also not required to pay advance tax. State with appropriate reasons whether following statements are true or false. Income tax can be revised only once. False. You can revise income tax return any number of times you wanted. Okay. Updated return under section 139(8)(a) cannot be filed if original return is a loss return. False. Even original return is loss return, you can file updated return, but updated return should have income. Okay. So all these are simple questions. When it comes to descriptive questions, I will make detailed video later. Okay. Thank you. I hope you are very much happy with this.